Federal Reserve Chairman Jerome Powell, in his monetary policy testimony to the US Senate, a regular semi-annual event, but the outcome was anything but the most powerful central banker in the world dashed hopes that the era of interest rate hikes was over. He in fact hinted that the pace of rate hikes could be quicker in the future.
As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time.
The biggest battle for the US Fed still remains keeping inflation within its 2% target range. Despite all efforts, inflation hit a 40-year high in June last year at 9.1%. It, however, cooled down to 8.2% in September and further to 6.4% in January, still far above the comfort levels of the US Central Bank. But what is really worrying Powell seems to be the recent surge in consumer sentiment in the US. The February figure hit a 13-month high of 67, up from 56.8 just 3 months ago. The figure reflects an unexpected bullish sentiment among US consumers. The fact that only a few believe that an economic slowdown might be around the corner. This also translates into high inflation expectations in the coming months.
The breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. It makes sense to moderate the pace of our rate increases as we approach the level.
The policy statement by the Fed chairman was countered by senators who believed that rising interest rates to reach the Fed target of 2% inflation could push unemployment rate, a political hot potato, to as high as 10%.
When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate. I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
I'm not asking you to again, blame anybody. But if history is right, unless you get some help in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all. Earlier today,
Jerome Powell, who was recently in India for the G20 finance ministers and central bankers meet, has overseen a rate hike of 425 basis points since last January. This triggered one of the fastest rate hikes in India, with the RBI raising rates by 2.5% in just 11 months. And with inflation still out of the target range in both countries, it's clear that more rate hikes are in the offing. Bureau Report, Business Today Television.
If you like the video, do like, comment, share and subscribe.